At this point, we've covered the basics of lease accounting, and we'll now turn to some more nuanced situations before we look at lease remeasurements and modifications. To begin, we'll look at a lease with multiple lease components. Recall that ASC 842 requires us to separate and allocate consideration to our lease components and non-lease components, although it does provide a practical expedient to combine non-lease components with their associated lease component. We took advantage of that expedient for both of our leases. With that said, ASC 842 does not allow separate lease components to be combined. Only non-lease components may be optionally combined with their associated lease component. So if a contract includes multiple lease components, we need to separate them and allocate the consideration accordingly. We did briefly discuss this earlier, but now let's look at a real-world example at Precision Industrial. So let's look at our most recent lease. Here we have the contract we entered into on March 19th, 2026, and you'll notice under the leased property and equipment section that it includes both an office suite in Chicago and equipment located in that office. Specifically, Section 1 describes that this lease includes a dedicated server rack with 6 servers, along with power distribution units and cooling hardware for those servers. So it appears we clearly have 2 lease components here. The office space and the servers can be used separately from each other, and each represent their own lease component. And remember, lease components are assessed independently for classification and measurement, even when they come from the same contract. Now, the power units and cooling hardware require a bit more analysis, but the lease states that these units were designed specifically for the servers. We cannot use the servers without the power and cooling, and the power and cooling units have no use other than for these specific servers. Based on that, the servers, power units, and cooling hardware together represent one lease component. Then if we scroll down to the next page, Section 2 states that the commencement date is April 1st, 2026, and the term is for 60 months. Then in Section 3, we can see our monthly payment for both the premises and equipment is $12,000 per month, payable in advance. So it's a much simpler payment schedule than we've seen the last 2 leases. One $12,000 payment over the entire term. Then there's really nothing else of note here, just some very basic language about delivery, usage. You can see in this instance we have no cost for common area maintenance, the landlord covers all of that. Our utilities are separately metered, so they fall outside the scope of ASC 842. Same with the insurance. Then 2 more basic sections about default and governing law. And finally, this lease includes an option to purchase the equipment at the end of the lease term, which we can exercise at our discretion, and it would require a $150,000 payment to purchase the servers. And I want to note that we have an option to purchase only the servers, not the building suite. So we know we have 2 lease components here, and that ASC 842 requires us to allocate the consideration in the contract based on the relative standalone prices of each component. But there are a couple factors here that make this more complex than it initially appears. First, we need to determine whether we are reasonably certain to exercise the purchase option in the lease. So let's assume for our purposes here that when considering the 4 economic factors on which we base our analysis, we've determined we are reasonably certain to exercise the purchase option. So we'll need to include that $150,000 as a lease payment to be allocated. Another complicating factor is how we'll go about determining the standalone prices of the 2 lease components. Recall that ASC 842 requires us to allocate the consideration in the contract based on observable standalone prices. And if observable standalone prices are not readily available, we need to estimate them. maximizing the use of observable information. Additionally, ASC 842 defines the standalone price as the price at which a customer would purchase a component of a contract separately. So to do this, we need to understand exactly what our two components represent. The building suite is relatively simple. The component represents the right to use the asset for 5 years. But the servers require a bit more analysis. Since we are reasonably certain to exercise the purchase option, the relevant period of use for valuation purposes is effectively the entire remaining useful life of the asset. So for this lease component, the most appropriate standalone price to use for an asset we'll eventually own is the current cost to purchase the servers outright. We're willing to pay a small premium to lease the equipment, because by doing so we can spread our payments out and we have the flexibility of whether we want to exercise the option to purchase or not. But if we were instead required to pay a lump sum on the commencement date to purchase this contract, and we're reasonably certain we'll own the asset at the end of the lease term, the cost we'd be willing to pay would simply be the price to purchase the servers outright, because that amount will almost certainly be less than the total nominal payments we'll make over the 5-year lease. But that presents a small problem. We aren't going to have an apples-to-apples comparison here. Because the building asset is only a right of use for 5 years, the most relevant standalone price is the lease payment of a similar building for the same term in a similar area. That will be the most observable standalone price. It's highly unlikely we could find a quoted lump sum price for this type of contract. But we can't compare a monthly payment for the building to a cost to purchase the servers. We could sum up the total estimated lease payments for the full 60 months and use that as our standalone price for the building component. But that does ignore time value of money. The fact that in today's dollars, a lease payment made today is not the same as a lease payment made 60 months from now. So how to approach this? Well, it's a judgment call. But from my perspective, trying to determine a market discount rate to determine the present value of the standalone building lease payments just adds in complexity and another estimation that probably isn't worth it. Remember, ASC 842 tells us to maximize the use of observable inputs. So for the building, we will simply sum up the estimated lease payments for a similar building over 5 years, and use that nominal amount to compare to the purchase price of the servers. So let's assume we found a quote for a similar building in a similar area for a 5-year term, and the lease would be $8,000 per month. Over 5 years, that represents a total standalone price for the building of $480,000. Let's also assume that our research suggests we could purchase similar computer servers today for $360,000. These figures then represent the relative standalone prices of the two components. Combined, they total $840,000, with the building representing 57.1% and the servers representing 42.9%. And that's how we'll allocate the consideration in the contract. So our $12,000 monthly payment will be split, with $6,852 allocated to the building and the remaining $5,148 allocated to the servers. And then, perhaps a bit unintuitively, the purchase option of $150,000 will also be allocated based on these same percentages. Even though the option is for the servers only, ASC 842 requires us to allocate all of the consideration in the contract based on the relative standalone prices of the components, regardless of whether contractually the payment is for one component or another. So we'll allocate 57.1% of the $150,000, or $85,650 to the building component, and the remaining $64,350 to the server component. So now that we've allocated the lease payments to the two components, let's quickly cover the classification of each lease. The servers are easy. Because there is a purchase option we are reasonably certain to exercise, the server component will be a finance lease. For the building, we'd need to do a bit deeper analysis, but it's highly unlikely the present value of the 5 years of lease payments is worth 90% or more of the market value of the building suite. And equally unlikely the lease term covers 75% of the remaining useful life of something as long-lived as a building. Additionally, this is not a highly specialized asset, and we won't obtain ownership, so we'll classify the building component as an operating lease. And let's assume our incremental borrowing rate for the building component is 7.25%, and for the computer server component, 6.8%. So before we enter these in our workbook, let's record the first monthly payment we'll make in advance of the first month, prior to commencement. Let's say we pay this on March 29th, 2026. So we'll debit our prepaid lessor payment account for $12,000 with the credit to our checking account. And if we save and close that, you can see our balance sheet as of April 1st, 2026 is reflecting this $12,000 prepaid lessor payment. So now let's go add these leases to our workbook. We'll start with the office space. This will be lease 3.0. We'll call it Chicago Office Lease. The measurement trigger is a new lease. The asset type is building. The initiation date is March 19th, 2026. The effective date is April 1st, 2026. And the termination date is March 31st, 2031 for a 60-month term. Then the incremental borrowing rate we said was 7.25%, and the classification is operating. Then while we're here, we can add the equipment component as well. This will be lease 4.0. We'll call it Chicago Server Equipment Lease. It's a new lease. The underlying asset type for this one will be computer hardware. The initiation date, effective date, termination date, and lease term are all the same. We said our incremental borrowing rate is 6.8%. And the classification for this one is finance. So we'll first create the schedule for our office lease. Because we've classified it as operating, we'll copy our 2.0 template as it's also an operating lease. Rename this to 3.0 and update our identifier to 3.0 as well. Then our lease schedule already includes 60 periods, so we don't need to update anything there. So let's now clear out and enter our payment schedule for this lease. Our first payment post-commencement will be on April 30th, 2026. And our final payment will be on February 28th, 2031 in advance of our final month. And of our $12,000 monthly payment, we've allocated $6,852 to this component. So that should give us 59 post-commencement payments of $6,852. And now for our lease payments, the last thing we need to take care of is that purchase option payment at the end of the lease. So this will occur on March 31st, 2031. And we allocated $85,650 of that payment to this component. Again, even though the purchase option is only for the servers, the letter of the law under ASC 842 requires us to allocate our consideration based on the relative standalone prices of the two components. And because a payment under a purchase option we are reasonably certain to exercise is treated as a lease payment like any other, we've allocated a portion of it to our building component. So now for the right of use asset, we'll clear out our information here. We made one payment pre-commencement, and so we'll allocate $6,852 of that to our right-of-use asset. And with that, we've now calculated our opening lease liability and opening right-of-use asset for this component. And if we just confirm that our operating lease expense is working out, you can see our straight line expense over the lease term will be $8,279.50 per month. And based on that amount, our right-of-use asset is amortizing to zero over the lease term. So now let's add our server lease. For this, we'll copy lease 1.0 because it's also a finance lease. Update the name to 4.0. Update the identifier as well. This was not a 60-month lease, so we'll need to add some rows to our schedule here to ensure we get to the end of our lease term. So we'll add 24 rows. And now we can work on our payment schedule a bit. This will also begin on April 30th, 2026, and on February 28th, 2031. And of our $12,000 payment, we've allocated $5,148 to this component. Then, just like our office lease, we'll add in the purchase payment on the last day of our lease term, so this will be on March 31st, 2031. And of that $150,000, we've allocated $64,350 to this component. Then in our right-of-use asset, we'll clear this out. Add the $5,148 as a prepaid lessor payment. And then for our amortization, we need to think about this a little bit. Because we'll assume ownership at the end of the lease term, we need to amortize this over the useful life of the asset instead of the lease term. So let's add a row here. We'll call it useful life in months. And this will be a hard-coded value. Let's assume a 7-year useful life for our computer server equipment. So we'll enter this as 7 times 12, then highlight that it's been hard-coded, and format it as just a number. Then we'll calculate our monthly amortization as the opening right-of-use asset divided by the asset useful life. So now if we check both of our schedules, you can see the ending balance of our liability is reaching zero by the end of the term, but our right-of-use asset is not. And this is expected because we will retain ownership of it at the end of the term. So now before we go, let's just update our check. First, we need to set this lease expense to our final row. So that will be our cumulative lease expense here. Then we need to do the same for our total cash payments. We'll link to that down here. And now, because we are amortizing this over the useful life of the asset, we need to include all depreciation recorded after the lease term as well. And notice I said depreciation, not amortization, because after the lease ends, we're no longer amortizing a right-of-use asset. We're depreciating the owned asset itself. So we'll add a line here for post-lease depreciation, and if we calculate this as the monthly depreciation multiplied by the remaining useful life after the lease term, which we'll calculate as the useful life of the asset less the lease term, we can see that our check is once again true. Over the entire term of the lease and the post-lease asset life, we'll expense an amount equal to our total consideration under the contract. So let's record our building lease first. This will occur on April 1st, 2026. We will first credit our current building lease liability. And you can see I've split out our building leases into 3 separate accounts. We haven't seen one for Denver yet, but we will in the future. You probably wouldn't do this in your chart of accounts at your own company. You just combine them into one building lease account. Maybe you could separate them out into sub-accounts. For our purposes, I've separated them out just to make it very easy to highlight against our lease schedules. So this will be our Chicago account. And our current credit will be for $55,819.67. Then we'll have our building lease long term. this will be a credit for $345,587.84. Then we will debit our right-of-use asset for $408,259.50. And finally, credit our prepaid lessor payments for $6,852. And you can see we're 1 penny off just because we're not rounding at all in our workbook and we're rounding to the penny in our accounting system here. We do need this prepaid lessor payment to be exactly $6,852. So let's just update our right-of-use asset by 1 cent as well. And now if we save and close and refresh our balance sheet, you'll see that we've recorded our Chicago building right-of-use asset, along with our Chicago current building lease liability and Chicago long-term building lease liability. Then finally, you'll notice that we still have $5,148 remaining in our prepaid lessor payments. That's because we need to record our initial measurement for the server equipment as well. So we'll create another journal entry, also on April 1st, 2026, and we will credit our computer hardware current lease liability for $42,931.31. We will credit our computer hardware long-term lease liability for $262,174.11. Debit our right-of-use asset for $310,253.42. And credit our prepaid lessor payments for $5,148. And now if we save and close and refresh this, you'll see that our prepaid lessor payment as of April 1st, 2026 is now cleared, and we've also recorded our computer hardware right-of-use assets, along with our computer hardware current lease liability and long-term lease liability. So with that, let's now quickly perform 1 month of subsequent accounting for both these leases. Since our building lease is an operating lease, we'll copy down our Austin lease template here, update the identifier to 3.0, replace the formula references to the 2.0 worksheet with the 3.0 worksheet. We'll also update the date reference from cell E17 to E27. And then we'll just quickly update our account names here because we separated these out. Our Chicago building lease current is 2300-0050, and this was building lease current Chicago. Then the long term was 2600-0050, and we'll add Chicago here as well. And then the accumulated amortization is 1400-0051, and we'll add Chicago. Then before we go any further, let's actually just add Austin to these ones quickly as well. Then let's update our reporting date to April 30th, 2026, the first reporting date after our Chicago office lease commences, and we should now be accurately calculating our subsequent periodic journal entries. So now for our computer server lease, let's copy down this 1.0 template as it's also a finance lease, update the identifier to 4.0, update our formula references from 1.0 to 4.0, and the date references from E7 to E37. Then we simply need to update our accounts. So for our computer hardware, this is account 2300-2000, and it's computer hardware lease current. Then for the long term, 2600-2000, and computer hardware lease long term. And then finally for the accumulated amortization, 1400-2001, and accumulated amortization computer hardware right-of-use assets. So let's now go account for April in our accounting system. First, we will act as our accounts payable team and will remit the $12,000 payment on April 27th. So we will debit our ASC 842 clearing account for $12,000 and credit our checking for the same amount. And if we save and close, you can see that $12,000 balance in our clearing account as of April 30th. So now let's act as our accounting team and perform our subsequent ASC 842 entries. And we'll combine these into one journal entry so we can see how this works. So this will occur on April 30th, 2026. First, we will credit our clearing account for the full $12,000. Then first for the building, we need to debit our operating lease expense for the interest portion. That will be for $2,348.13. Then we'll credit our building lease current Chicago for $326.53. Debit our building lease long-term Chicago for $4,830.40. Debit our operating lease expense for the amortization portion for $5,931.37. And credit our accumulated amortization building right of use asset Chicago for the same amount. Then for our computer server lease, we will debit finance lease interest expense for $1,677.28. Credit our computer hardware lease current for $236.01. Debit our computer hardware lease long term for $3,706.73. Debit our finance lease amortization expense for $3,693.49. And credit our accumulated amortization computer hardware right of use assets for the same amount. And now if we save and close, you can see we've completely cleared out our ASC 842 clearing account. And then let's just spot check one of these. So our building right of use asset Chicago is currently $402,328.14. And if we look back at our workbook, as of April 30th, 2026, sure enough, we're tying to our ending balance of $402,328.13. Off by 1 penny due to rounding. We won't check every balance, but we have included the balance sheet, income statement, and lease workbook as files linked to this episode, so if you want to confirm for yourself that everything is tying out, you can certainly do that. And with that, we've recorded the 2 lease components that were part of the same contract. As a bonus, we also looked at a lease that included a purchase option we are reasonably certain to exercise. So the right of use asset was amortized over a period other than the lease term. In the next episode, we'll continue to look at some more nuanced situations and turn to lease incentives.